Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So as the Nasdaq 100 continues to climb in a euphoric move, it continues to drag the rest of the stock market, the S&P 500, higher, now making a new 9-month highs. The Nasdaq 100 actually making 52-week highs, while the number of stocks above their 50-day moving average in the S&P 500 is actually now below 35%. This is weaker than anything we've seen on any rally that we've seen throughout the past 20 years. The only moment we actually saw this was at the very top of the dot-com bubble, where the entire market was being driven by the technology sector that is now beginning to reach extreme valuations not seen again since the technology bubble in the 2000s. History doesn't repeat, but it often rhymes, and this is exactly what we are seeing today. By the way, don't forget to click on the like button down below if you enjoyed this video, and of course subscribe to the channel if you haven't already. Now without further ado, let's get right into it. So again, the S&P 500 making a new 9-month high here, and what you could arguably say is a breakout above this price channel here. The S&P 500 really trying to take out all bearish structures in the market, being primarily driven by the Nasdaq 100 that is actually reaching levels not seen since April of 2022. And this is all happening with very few stocks actually participating in the rally here. So less than 35% of stocks are actually trending higher. If you think about what that means for the S&P 500, it means 325 stocks out of the 500 S&P 500 stocks are actually trending down right now, while the S&P is making new highs. That is truly spectacular and quite unprecedented, except for maybe one moment in history. These breadth indicators, right, this very simple measure of participation on the S&P 500, just the percentage of stocks that are above a certain moving average. That's something that at gameoftrades.net we've used many times before to try and time bottoms in the market. And this actually works incredibly well. When you have breadth that's oversold, you get a bottom, right? Breadth oversold, nearing a bottom. Breadth near oversold, you get a bottom. So what's happening right now, and this is the Nasdaq 100 here, that's making new highs while breadth is near oversold, is quite strange. Now I can show you that very simply by just putting red dots every time that this indicator is actually below 35%. And you can see if we zoom in a little bit, this type of reading, these red dots appear when the market is experiencing a correction. When the stock market is seeing a violent move down, you tend to see the breadth weaken, and that typically happens near bottoms, whether that's on the S&P 500 or on the Nasdaq 100. I'm going to quickly scroll through history so that you can get a glimpse of all of these moments where you actually have this type of oversold reading. They systematically happen around corrections in the market. This doesn't happen when the market is making new highs or just when it's recovering off a major low. That can happen as well. And this is just true throughout history. You get these readings during a correction in the market, whether it's a small correction or a larger correction. They happen when the market is going down. So what is happening right now as we speak with the Nasdaq 100 making new 52-week highs, the S&P 500 making new 9-month highs, while the breadth is oversold. This is truly spectacular, and we actually have to go back to 2000 to see anything like this. Here in February of 2000 and March of 2000, look at what the Nasdaq 100 was doing. It was going on a melt up here, while most stocks within the S&P 500 were trending down. Most stocks were in oversold territory here. And you had a very similar type of thing in 1999 here, stocks making new all-time highs in October of 1999, while most stocks were trending down. This is the only comparable moment to what we're seeing today. And you can check this data out yourself, but this combination of a euphoric move higher while most stocks are trending down only happened briefly in 1999 and briefly in the melt-up leading to the top of the dot-com bubble in March March of 2000. And just so you can see what that looks like on this chart, this is what was happening here. October of 1999, you had a few red dots here. You had this type of development that was starting to happen. And then all the way to the top in February and March of 2000, you had the exact same thing. So an extremely low number of stocks that are pulling the entire market higher. So this lasted between October of 1999 to March of 2000. So that's 4 or 5 months. So this is another example of where the market can remain irrational longer than you can remain solvent. If you were betting heavily short on the market here in October of 1999, you were absolutely right to do so, given how weak the participation was right here and how overvalued the stocks were and how irrationally euphoric the market was being right here. But from a timing perspective, you would have been absolutely wrong. You would have gotten squeezed massively until March of 2000. By the way, this video is sponsored by our company, Game of Trades. Instead of doing irrelevant product placing, we much rather show you our service at gameoftrades.net. We are on a mission to build the best service for individual investors. And this is really truly the beginning of our journey towards helping a maximum number of people actually be successful in the market. For now, what you'll find on our website is that we have a global macro trading strategy that you can apply as you wish, picking and choosing the best ideas or following the entire model portfolio through our portfolio updates. We also highlight investment ideas, explaining both the technical and fundamental reasoning behind them. This is an extremely tough market environment. We're seeing market behavior that we've only seen a handful of times in history, with a sticky inflationary backdrop, a historically aggressive Federal Reserve, and huge similarities between the behavior of the market today and 1999. And that's exactly what we want to do with this service, is to help investors make better decisions in these types of market environments. So grab a free trial by clicking on the link down below if you are interested in our service. Now let's get back to the video, because something I said at the beginning of the video is that the valuations of these stocks are comparable to 1999. And I showed you this chart right here of the PEG ratio in orange here. Now this is a bit different to the PE ratio, because the PE is just the price that investors are willing to pay for the amount of earnings the S&P 500 makes. But the PEG ratio is the price that investors are willing to pay for the growth of earnings. And so this is a very important metric to look at if you want to be identifying a bubble, because a bubble, for example, 1999, forms when investors are extrapolating a lot of optimism based on how well these companies are doing at that moment. So let me give you the example of Amazon. Back in the late 90s, this was a company that was growing extremely quickly, and investors knew that and were willing to pay a lot of money to have exposure to that growth. So when you have an environment where investors are trying to extrapolate optimism, you can't just take a look at today's earnings. You have to take a look at how quickly earnings are actually growing and how much investors are paying relative to that. And you can see here, for example, in 1998, the PEG ratio wasn't actually that elevated. So in 1998, these stocks were not in a bubble. You basically just had the tech boom that was so intense that earnings were growing so quickly that it actually made sense for investors to bid these stocks up very high. Then in 1999, you started to see euphoria, because investors all of a sudden were paying a lot more for the same amount of growth. So that's where you started to get euphoric type of behavior in the market, where valuations were no longer justified, even when you compared it to the strong growth in the industry at the time. That's exactly what we are also seeing today. A lot of people right now are pointing to Nvidia and saying it's growing so quickly, its earnings are growing so quickly, so it's okay if investors are paying a big premium for this type of growth. But you actually look at the PEG ratio for the S&P 500 throughout the last 30 years of data, and we are definitely seeing some irrational behavior here. That, by the way, we saw in March of 2000 right here, and also surprisingly during the 2001 bear market rally right here. So even during this rally, investors were overpaying relative to the growth that these companies were. And this is also because of the fact that we were experiencing a tech bust where these companies were basically collapsing. And so while earnings growth was very strong here during the optimistic period of the late 90s, here during the tech bust, earnings were actually crashing and investors hadn't yet adapted to that new reality. And we also saw this reading here in 2020, and that was actually very much justified. That reading occurred around May of 2020. Investors were extrapolating the fact that the pandemic was going to generate massive earnings looking forward. Investors here were extrapolating that the pandemic was going to benefit tech in a big way and that the stimulus would create a massive economic boom. And this is what triggered the V-shaped recovery we had in 2020 because the market immediately understood that stimulus was going to have a massive impact on economic activity and was going to trigger an earnings boom, which did materialize. So where do you think we are? Is this more similar to what we had here in May of 2020? Or does this look a lot more like what was happening at the height of the dot-com bubble? I hope you guys enjoyed this video. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.